Hello and welcome to GamesHUB, a crypto talk show with our investors, partners, and remarkable personalities. I'm Constantin Kogan, co-founder of GamesPad, and we're excited to welcome a very special guest today. Meet Yida Gao, who's a managing director and partner at Shima Capital, an early-stage global venture firm focused on supporting cutting-edge blockchain startups. We're glad to share that Yida entered a famous list of Forbes 30 under 30s, and we're more glad that Yida is actually our investor and our friend. So welcome, Yida.
Thank you for having me, Constantine.
Yes, it's really a pleasure. And since we started hearing about crypto, there's been like three different bear markets and three different cycles. I know that you participated, like in crypto for quite a while. And curious to hear about your journey a little bit, like, and how's the current bear market different from the previous ones in your experience?
Yeah, sure. Happy to give a little bit of insights here and a little bit about where we started. I started off my career doing investment banking. So worked on Wall Street at Morgan Stanley, doing M&A banking, and quickly realized that the existing financial infrastructure is a little bit backwards. So I got out of that, packed my bags, moved over to the West Coast, and worked at at the time the largest VC fund in the world, which was NEA, New Enterprise Associates. Started there in 2015. Tried to source fintech deals, and part of that was looking into crypto. Back in 16, 17, really tried to get a couple of deals through the partnership, but could not as it related to crypto. So I left, started my first crypto fund called DDC. It was more of an open-ended hedge fund. And then fast forward to last year, raised a closed-ended venture fund, Shima Capital, which is focused on investing into early stage, pre-seed, seed investments in Web3. We want to be the first institutional checks into these companies. The observation we made is that over these many cycles, as you know, Constantine, a lot of funds in the crypto space have ballooned in size. And so it's hard for them to invest into seed pre-seed where the check sizes are generally smaller. We see that as a good area for us to in pocket of opportunity for us to come in with a check that allows us to have the kind of power law returns that you see in the space, and have that margin of safety given how volatile the market is in terms of lower valuations. And so that was the thesis. We were lucky enough to raise around 200 million for the fund, and we are a generalist fund, so investing across all of the exciting verticals within crypto, from infrastructure to gaming. Gaming is actually one of our largest sectors, and we have 3 investors on our team that only focus on gaming metaverse type of investments. And to answer your question regarding how this cycle is a little bit different than others, I think every cycle has kind of the large movement of token prices, and from the last cycle it was about ICOs, right? As you remember in 16, 17 into 18, and it was just the ERC20 standard made it easy for investors, retail investors, institutional investors to invest into projects. And because of how easy it was to invest, we didn't really see a lot of projects that actually had traction and product raising capital. A lot of them were doing so very easily. And the types of investors on the institutional side were very few. And so what I see as the difference between this cycle is that you have more institutional investors coming into the space. Traditional venture funds on Sand Hill Road, Silicon Valley, were standing up crypto-specific funds to invest into the space, into tokens that you didn't really see in the last bull market, last cycle, and especially the cycle before that, because ERC20 standards and altcoins were not even a thing. So that I think that's a big difference. I think that different types of categories like gaming has come up in a very real way. last cycle, there weren't really gaming companies that were raising capital. If you remember, a lot of it was infrastructure bets, layer one protocols from Polkadot to a Solana. And now, we're moving up the stack, closer to the consumers, closer to retail and users. And so I think, for this conversation, this talk, we want to talk more about that side of the spectrum, which are gaming companies and that entire market, which we believe is very, very obvious as the low-hanging fruit opportunity for crypto adoption.
So it's interesting that you mentioned you were kind of more sector agnostic, right? And I know you have a huge portfolio of companies across like infrastructure, gaming, right? But in your opinion, like to be objective, like what sectors within Web3 are particularly attractive for VCs right now? Because we hear a lot that people invest only in infrastructure and they're like slowed down on gaming a lot, right? So what is your stance here?
I think a lot of VC, if you just take a random VC fund that's investing in crypto right now, they'll probably say infrastructure, right? And the reason why they're saying that is infrastructure projects take longer to mature, and they take they just are larger projects. And right now in a bear market, it's hard to think about the contrary, right? How do you get retail investors to invest in a consumer app or use a consumer app in crypto when you're in a bear market? So if you just take the opposite of that, then the other end of the spectrum would be infrastructure. And bear markets are great for infrastructure companies because one, it's cheaper to hire engineers, right? You need more engineers and you need more talent to build these longer lasting infrastructure plays. So that's one. And in a bear market, you can hire easier, and it's more cost efficient. Two, as what I hinted at before, which is the market, right? The retail market, which crypto is very much driven by retail, as you know, at least now, given how nascent the industry is. The retail market is not really there, right? To buy, the NFTs, to buy tokens on a decentralized exchange or a centralized exchange, like in a bull market. So that caters to more of a infra kind of mindset. And then three, with all of the issues that have gone on with FTX, Solana, Luna, and all these blowups, we realized that we need to go back to the basics, foundational level of investing. And there's a lot of things that needs to be built out on the layer one infra level that can bring the next kind of wave of interest into the space. And I think infrastructure plays because they have a larger opportunity. It's easier to underwrite these types of investments, relative to potentially high grift and also high risk of consumer plays.
So there's another question which comes to the following one. So a lot of folks obviously switch from tokens to equity, right? So you're still deploying to tokens, and it's a contrarian view, I would say, as opposed to others. So can you explain a little bit, like, for people who are just getting into the space, what's the main difference and why you still prefer to deploy to both?
Yeah, I think for us, right, we love the shorter time to liquidity of token investments. We also understand the downside protection that you get from investing into equity. So when we issue term sheets and negotiate deals, we typically are looking for both. And the pendulum has swung from a seller's market to a buyer's market. Buyers meaning investors, sellers meaning companies, founders. And so now that it's a buyer's market, investors, with capital, cash is king, have more of leverage. We're negotiating both the equity and the token, which makes sense, right? Because in a bull market, you kind of are you kind of have to bend a little bit to the market, and if all of the companies that you would want to invest in are only issuing SAFs or selling tokens, if you want to have exposure, then you may need to just only purchase the tokens. But with tokens, you don't really have a lot of control and governance. And as the blow up of FTX has shown us, we need more governance and control in this space. And so that's why we are kind of moving more towards traditional venture investing, which is having an ownership stake in the equity. But we also are a Web3 native fund, and we understand the benefits of having a token. And if you are a Web3 native company, then you need to design a token that can be sustainable and make sense for your project. So it's not a requirement to have a token, but I would say 90+% of our investments have some sort of token component.
So maybe you can describe one particular deal that was lately, and the reasons why invested, to just explain the example. How are you looking at the market right now?
Sure. So let's see here. One of the companies that we invested, you're asking for a company that we've invested in recently that has both a token and equity?
Recently. And this particular bear market, I think it's very important for people to hear that from the fund that is still deploying, why and how are you looking at the market, right? Because sometimes there is like this depressive sentiment that oh, no one is deploying and we have to wait for a year, which is not true. We clearly see that you guys are active, right?
Sure. So I'm just trying to think which ones we've announced. Yeah. Yeah. I mean, we've so there's a company that we've invested in that okay, so let me take a step back. So right now, in any type of winter or bear market across Web3 or Web2 or Web1, people are going back to profitability compared to growth, right? They care more about sustaining a business that makes sense from a revenue perspective. And a lot of projects, as you know, do not generate a lot of revenue in crypto. A lot of it is based on increasing in token prices, network value, et cetera, et cetera. So we're really focused on looking at companies that have sustainable business models. And one category, right, that we were always interested in was in the category of having user acquisition methods for bringing more people into Web3. And what's something that what are some of the largest companies in the world today? Well, they are companies that sell ads, right? You have Facebook, Google, they make money by selling ads and acquiring users for brands and others who are paying for those ads. That doesn't really exist natively in the Web3 world. And we believe that there could be very interesting ways to sell ads in Web3 where maybe you don't need to own the data of the user. But if you think about cookies and how they work, like internet cookies, the wallet that every single user has, a gamer playing a Web3 game to a trader doing DeFi, that wallet can act as a cookie, caching a lot of information for that specific wallet address, and that can be tracked. And what's interesting is that wallet address, that cookie, gives you more insights into that holder of that wallet than a traditional cookie in Web2, because you have financial information. It's like if you had access to the bank account of every eyeball viewing a Coca-Cola advertisement. And so we think that there's something there. It's a large market in terms of ad revenues in Web2. And so a recent investment we made is in a company that is trying to build the Web3 version of Google AdSense or AdMob. And I think this applies very, very well into a lot of different verticals, including gaming, right? With Apple cutting off a lot of the tracking that goes on in their phones for game developers, it makes it increasingly hard to pinpoint how to serve ads and appropriate ads to gamers. So I think a Web3 version or a method could be a nice narrative for the next bull market.
Interesting. So listen, I would love to ask you like dozens more questions, but the purpose of this stream is also to make sure our users, like our listeners are asking you directly. So we're gonna open the questions from the audience. There's already a lot of them. It's gonna come from YouTube Live, Twitter Live, LinkedIn Live. So I'm just gonna read it to you directly, and then I'll provide the answer. So Charlie from YouTube is asking, so I've read on VentureBeat that 55% of crypto developers say the bear market has increased their desire to build. In your observations, how has the bear market affected the developers and you personally know?
Yeah, so in terms of the developer kind of activity in the space, that's definitely something that we look very closely into. Electric Capital does a really nice annual report about developer activity in the space, and we look at it from on-chain data and also looking at GitHub across different types of major projects. And we really haven't seen a slowdown of developers coming to the space. And I think a lot of developers who were shying away from crypto and Web3 in a bull market because of all the craziness and volatility that you see are now more interested than before the crashes of today. And they realize that it's quieter now. It's a good time to really get into the space, and it's actually also a good time to reach out to founders of projects, and it's easier to start conversations with folks at major projects that maybe you otherwise would not be able to chat with before. And there are more tooling and also languages now that developers that make it easier for developers to get into the space. We're fairly bullish on the new types of L1s coming out that are built with the MoveEM language coming out of Facebook. It makes it very easy to build smart contracts and abstract away security in a way that is safe. And that's something that we think is going to be a good bullish sign for more developers coming into space.
Mm-hmm. So Captain Huddle from YouTube is asking, AI has recently become a trend for investors. Do you see a model where AI and Web3 are integrated? Do you think it's a good match?
Yeah, I mean, theoretically, it should be, right? It should be a good match. If you think about all the AI models that are getting created, ChatGPT with DALL-E 2 and all this stuff coming out of OpenAI and others, it's a little bit scary, right? And how do you know what's real, what's not? Exactly. One thing that crypto and blockchain technology enables is verification, right? You trust code. Code is law. And if you can marry the two together, then I think it's theoretically, as I mentioned, it makes a lot of sense. I think for AI, the value, right, is going to be in the data sets. There's a lot of middleware companies, tooling companies getting built right now, but I think the value is going to be in unique data sets that companies can create, and crowdsourcing that data or getting that data in a way that protects protects the owners of that data through blockchain could be a way that AI and blockchain can have a happy marriage together.
Yeah, there's one question from LinkedIn, Mike, that you already answered. It was about like infrastructure and technology, so probably going to skip that. But there's another one interesting from Twitter. So Ulusan11 from Twitter is asking, Nike recently announced its own Web3 platform, Swoosh. Do you predict an increase in investor confidence from seeing the big brands interested in the space?
Big brands coming into the space. So I think there was a massive interest in big brands coming into space, especially on the metaverse NFT side of the business, consumer side. And that is kind of trickled out and slowed down dramatically. I do still think that there's going to be a massive influx of brands, again, on the advertising side, right? Why do big brands want to come into the space? When you're talking about consumer brands, it's usually novel ideas that can that can help increase the wallet size of their existing users and retail folks, consumers, or it's novel ideas that can help bring in new consumers for their brands. And I think crypto is and can still meet those needs, but it's going to require better business models than existed before. Just creating 10,000 NFTs and selling that it's not very sustainable. So we're seeing a lot of interesting, what I consider functional digital assets or NFTs that can be used by brands, but it'll take time to really think through all of the good business models that should exist. I do think one interesting opportunity for brands is getting into gaming, which is how do you have brands kind of get into games through NFTs or through digital assets, and kind of make it a very natural way for them to insert themselves into consumers that they otherwise would not be able to see. But I don't think brands are going away. It's just we need to make sure that the models work for them, and also the projects, the crypto projects. And in this bear market, you have more time to think through those business models.
Mm-hmm. I actually think that it didn't slow down a lot, because if you look at it, I watched the Porsche NFT collection, which is very well designed, and sold out really fast, and a few other big collections, that are, they just take more time to prepare and to plan it strategically, and some of them are doing pretty well. So yeah, you're correct that it requires a little bit more preparation, probably, and more meticulous planning, and making sure it makes sense for their business model. But yeah, I'm sure we're going to see even more, even during the bear market.
I think with Porsche and other brands that are launching or dropping NFTs, there's a lag period. So the higher the quality, right, of the drop, if we're talking about NFTs, the longer time it takes to get it done. But in terms of new kind of projects getting started today with brands, I think that may slow down, at least from what we're seeing in terms of our portfolio companies, pitching today brands for a metaverse play or whatever. But yeah, I think the quality is definitely going to increase, which is great for consumers, great for brands and companies.
100%. There's an interesting question. NFT Boom 47 from Twitter is asking, I've read that regenerative finance, ReFi, is going to be a big trend in 2023. How does it differ from DeFi, and how do you see the future of it?
Yeah, sure. So we actually have made a couple of investments in the ReFi space, Klima DAO, open force protocol. I think that this is, the climate side of things, climate control, all the issues going on with global warming, massive market. The voluntary carbon market is growing, double digits every year. And it's a real problem. And I think I think blockchain can solve, help solve some of the problems in climate. And the term ReFi, right, is to me, it just means how can we use token design, blockchain to better the world that we live in, and make financial incentives, again, going back to token design, that makes sense for players in the space that otherwise would not be involved. So one example is a very concrete example is of a company called OFP, Open Force Protocol, and they are trying to displace a lot of the middlemen when it comes to creating carbon credits, right, which are typically controlled by monopoly of Vera, Gold Standard, oligopoly, and so what they are doing is, instead of just there are projects out there in the ReFi space that are just taking existing carbon credits and bridging them on chain, and for us, we don't think that that's as interesting as creating and minting new carbon credits directly on chain without needing to bridge or anything like that. And so when you do that and you're originating carbon credits on chain, what that means is you have a higher fidelity of carbon credits that can be tracked on chain, have full provenance, which is one of the key components of blockchain, is that every single transaction can be tracked on chain. And arguably the carbon credits that you're minting and creating that originate on chain are of higher quality, and you can sell them for a higher cost than kind of carbon credits that are stale or that get converted from a Vera registry to on-chain token. So that's the one thing about carbon credits being on chain, is that it has full provenance. The second thing is you can utilize validators, whatever you want to call them, miners, to verify the carbon credits instead of having expensive consultants fly to your project, your forest or your mangrove, and a lot of the profits are going to these expensive consultants to verify your carbon credits and for your project. You can instead use validators and and not have one centralized entity or a couple of centralized entities determine if those carbon credits are worth anything. And so I think there's definitely a lot of interesting things going on with ReFi, and open forest protocols. One good example to look into if you're interested in that space.
Mm-hmm. Thank you. There's one provocative question I will ask you. So it's coming from Nakamoto-san from YouTube. Do you agree with how Binance and CZ handled recent crypto issues? Do you expect this exchange to become a monopoly in the industry? How would that affect retail investors?
Yeah, I think we need to go back one exchange that is now bankrupt, which is FTX. And I think what FTX taught us is that we shouldn't be keeping our tokens on chain. We shouldn't be keeping our tokens in hot wallets and having the custody be owned by somebody else. Not your keys, not your coins. So I think that is something that should exist, and that's good kind of token hygiene for retail investors, for institutional investors. We don't keep a lot of our tokens on any exchange where we don't own the keys. And I think it's a hard lesson to learn. And it goes for Binance as well. A lot of folks are withdrawing capital from Binance, but the billions that are getting withdrawn from Binance shouldn't have been there anyways. And so this Binance FUD may be doing a service for the industry. I don't think Binance is insolvent. I don't know the answer to that. And there may be more just FUD around regulatory and compliance issues. That may be true. But I think the lesson for consumers is that you shouldn't be keeping your coins on a centralized exchange, which is hard to. It's a hard lesson to learn, and it's also consumer behaviors that's not consistent with the 99% of their lives before Binance was a thing, because we keep our fiat dollars in the custody of JP Morgan Chase and other types of banks. So it's a different mindset, and it'll take time to convert people to this 100%. New paradigm.
There's another question from Raphael from YouTube. Despite a 24% drop in Q3 fundraising, it's still 2.7 billion higher than last year. The correlation with prices seems to be breaking down. What can we attribute this to?
So can you repeat the question? So the question is the fundraising in the market.
Yeah, I think he means like specifically in Web3 fundraising that it's there's a 24% drop in Q3, but still 2.7 billion higher than last year, and I think in total, right? So so what do you think? Why is that happening, even though we're in a bear market?
It's because of how funds work. They raise capital, but they don't deploy all that capital in the same year that they raise it in. So there's a lot of dry powder that has been raised and still hasn't been deployed in funds, institutional funds that still need to be deployed. And so the price of Bitcoin, right, price of crypto moves 24/7, but there's a lag period on how fast those funds can be deployed from the private markets. So that's another kind of North Star, or like light at the end of the tunnel, right, for developers and founders that are trying to build in the space, is that although there's been a massive decrease in prices, token prices, decrease in funding. That decrease in funding should pick up into next year as the dry powder needs to be deployed.
Mm-hmm. I think, to wrap up, we'll ask you the last question, which is I think very good for the summary. So Stable Person from YouTube, what are the top 3 lessons from this crypto winter? And do you have new principles in how you invest?
Sure. I think there are a couple of new lessons, but I think it's just like kind of reaffirming some of the lessons that we've learned in the past from investing in traditional VC that should be transitioned over to Web3 investing, which come down to making sure that you do your diligence, right? I think a lot of VCs in the Web3 space do not do enough diligence, and that can lead to the kind of craze in fundraising environment for certain companies that should not have raised so much money. So just reaffirmation that investors should take our time before we deploy a check. And then 2, when you're negotiating those investment term sheets, make sure that you have proper checks and balances in place, governance, boards. One thing that Web3 companies, I was just talking to a founder this morning, do not have a lot of is the concept of having a board of directors. And because you're a lot of times selling tokens, you don't have actually, as an investor, ownership into the company and equity. So there's less concept of a board, but making sure that you have the right controls and governance for your investment that you want to make. So boards being one component of that. And I think the second is, what we're thinking hard about is a lot of these vesting schedules, right? I think one lesson learned here is that, and this is also carryover from the last bull market, which is these vesting schedules for tokens are fairly fixed. You have, let's say, a 3-year vest, 1-year cliff, and then you get monthly or weekly unlocks. And we're trying to think about, more dynamic ways to have vesting where it's tied to growth, it's tied to engagement and traction of the company. And I think that's something that we've, learned in spades, especially going through this cycle, which is, these finite fixed vesting schedules that get deployed in smart contracts may not be the best for investors and the companies and everybody involved. So, I think the next bull market will come out with, more interesting vesting schedules that may be tied to traction and growth. We have a company called Magna, which is kind of building a Web3 Carta, capital management, but other interesting things around vesting that I think will be pretty interesting for the next bull market.
Perfect. That's flexible investing. Yeah, it is a big topic. So it's like a separate conversation we can have for half an hour, right? But thank you, Ida. Like really, thank you for all your answers. I'm sure the audience had a great time hearing from you, learning from you, and we hope to have you more again. Thank you everyone for joining GamesHUB today. So we're going to see you around 2 weeks, exactly at 4 p.m. UTC, 11 a.m. EST on YouTube Live, LinkedIn Live, Twitter Live, all the lives. And then please follow Shima Capital. They're one of the best investors in the industry. All the links will be provided in the description. And Yida, I'm sure he's very popular now, becoming very popular. It's like a LinkedIn and Twitter, so you can follow him there and read all the news, and he has an amazing team. So I'm sure you're going to enjoy just following Shima Capital's path. Again, thank you so much, Yida, and have a great day.
Thank you.
Cheers.